Hello, I'm Haider Malik, host of the Mehmi Financial Group podcast. Today's topic is e commerce fulfillment growth, working capital for Surrey warehouses. As online order volumes surge, your warehouse faces spikes in inventory purchases, labor costs, and technology investments, often before you invoice your clients. Here's how Surrey 3PLs and fulfillment centers can layer working capital tools to fund growth without derailing cash flow. 1. Why a dedicated working capital facility? Bridge timing gaps, cover pallet tracking, pick and pack labor, and software licensing between order placement and client payments, which often take 30 to 60 days. Preserve term lines. Keep your equipment loans and real estate mortgages intact. Use a revolving facility exclusively for operating expenses. Let them scale with volume. Easily expand borrowing capacity as you onboard new e-tail clients or add peak season shift premiums. 2. Loan structures to consider. Receivables, secured revolver. Structure. Pledge approved fulfillment invoices to advance up to 80% of face value. Draw, repay, and redraw as orders ship. Benefit. Interest accrues only on used balances, matching costs to revenues. Inventory backed line. Structure. Use inbound stock, seasonal goods, packaging supplies as collateral for a revolving line with 50 to 65% advance rates. Benefit. Fund bulk buys or pre-tier inventory for flash sales without tapping your credit card limits. Short-term seasonal loan. Structure. 3 to 6 month term, amortized to match your busiest quarters at prime plus 1.53%. Benefit. Smooths out one-off surges, Black Friday, Cyber Week, without long-term debt commitments. Equipment line of credit, ELOK. Structure. Pledge forklifts, sortation conveyors, or automated storage systems as collateral for a revolving facility. Benefit. Finance technology upgrades, paying only for the draws you use. 3. Finding the right lender. 1. Local banks and credit unions. Surrey and Metro Vancouver institutions often tailor programs to regional supply chain cycles. 2. Specialty finance firms. Non-bank lenders underwrite based on your shipped order volume and contracted pricing models. 3. Government programs. The Canada Small Business Financing Program covers working capital loans up to $1 million, sharing risk and lowering your spread. 4. Key terms to negotiate. Interest-only draw periods. Pay only interest during inventory buildup and labor ramp up, then amortize principal as client payments arrive. Flex up options. Ability to increase your facility without full re-underwriting as you sign on new e-commerce brands. Covenant light. Favor borrowing-based tests, receivables inventory values over rigid coverage ratios to accommodate seasonal swings. Prepayment and renewal. No penalty lump sum repayments when large invoices clear. Option to extend or top up as volumes grow. 5. Managing your facility. 1. Strategic drawdowns. Borrow immediately before major payables, inventory receipts or payroll runs to minimize average outstanding balance. 2. Rapid repayment. Funnel high margin order revenues into principal reduction to restore capacity for the next surge. 3. Monitor KPIs. Track days, sales outstanding, DSO, and days payables outstanding, DPO. Aim to keep DPO at least 5 days longer than DSO for a positive cash cycle. 4. Transparent communication. Keep your lender apprised of new client contracts, technology deployments, or facility expansions to maintain trust and speed future draws. 3 action steps. 1. Audit your needs. List your top 4 cost drivers: inventory buys, seasonal labor, automation upgrades, software licensing, and map their timing against expected client payments. 2. Solicit proposals. Request term sheets for receivables revolvers, inventory lines, seasonal loans, and ELOCs from at least 2 banks and 1 specialty financier. Compare advance rates, spreads, fees, and covenant flexibility. 3. Model and deploy. Build a 13-week cash flow forecast, simulating a 20% volume spike or a 30-day payment delay to ensure your chosen mix covers peak to off-peak gaps. Then execute draws according to your plan. By combining receivables, secured revolvers, inventory facilities, short-term loans, and ELOCs, and by rigorously forecasting staggering draws and negotiating flexible terms, you'll secure the working capital to scale your Surrey warehouse operations in step with booming e-commerce demand. I'm Haider Malik. Thanks for listening.